You were not meant to be a slave to the grind. You were not meant to trade your life force for money. You can escape gravity. You can unlock your life. You got this. Let's go.
Hello and welcome to Unlock Your Life. I'm your host, Jennings Smith. Guys, today I want to talk about where are we going? Where is the economy going? What's the Fed doing? Are they still going to raise rates? Have they pivoted? Are we going to see the rates that we saw a couple years back? Are those on the horizon? How do I make decisions around that? Are we about to fall off a cliff? Should I just hang on to my cash and wait for a rainy day? Should I keep buying because the market's going to go up and I've got a lot of optimism? How do I make deals work with this high rate interest environment that we're in? What do I do? Well, I don't know all the answers to those questions. If I did, probably Jerome Powell would be calling me up. But I do have some opinions on that. I do have some thoughts. And one thing that I've noticed is the crowd is usually wrong. We've seen this in stocks. We've seen this in real estate. I was just talking to a guy the other day who said he sold everything in 2015 because he believed it was the top of the market. Things were about to crash. I talked to another guy. He sold all his real estate off in 2019 and he missed probably the best run up in real estate prices that we've seen. In 3-4 years, prices were going up crazy during COVID. The crowd was absolutely pulling back in the beginning of 2020, probably all through 2020. The rates were starting to come up a little bit, maybe. And we had COVID. Actually, no, the rates weren't coming up yet, but COVID was coming in. COVID was coming in and nobody was going to pay their rent. All these companies were going to go bankrupt. We were supposed to shelter at home, stay at home. Nobody was working. And this was not a popular time to be buying real estate. And the deal that I bought in June of 2020 has turned out to be one of the best deals that I've done in my career, just because we had the guts to proceed and say, we know this is a good deal. The numbers look good. This deal makes sense. Let's march forward with the deal. And, now we're on the brink of selling that at a pretty healthy profit. And so I've seen the crowd always be wrong. And what I'm seeing right now is the crowd is scared, right? The crowd is very, very nervous about buying real estate. Real estate transactions have softened up, and I'm talking about commercial right now. I'm talking about multifamily because that's what I know best. But we're seeing a lot of hesitation. We're seeing groups that they're looking at deals, they're underwriting deals, but they're not confidently making those offers. They're not following through. And it seems like there's a whole lot of buyers that are just sitting on the fence. They're just kind of waiting to see what happens next. But the problem with waiting to see what happens next is by the time you figure out what's happened, usually it's too late. And so I want to talk about some of the things I'm seeing, what I'm doing, and what I think you should be thinking about as we go through the next, 12 to 24 months. Today is October 4th, 2023. So as I'm recording this podcast, the Federal Reserve just had its September meeting. They decided to hold rates steady. So if you follow that, you know that they did not raise rates. They did not lower rates. Their target right now is 525 basis points to 550 basis points, which equals, 5.25% to 5.5%. And so you may think, well, why are rates higher than that? Well, that's because there's spread that the banks are adding on to that so that they can make money as well. But the federal funds rate is 525 to 550. That's their target. That's what's floating around right now. And everybody's looking at that number because that number, it drives a lot, right? It drives all the commercial lending, self-storage, office space, multifamily. It drives your single-family mortgage, right? Single-family mortgages are 7.5% to 8% right now. Whereas a year and a half ago, you could get a single-family mortgage if you had great credit, for 2.3 to 2.8%. Insane levels of low interest, and that fueled a crazy economic cycle in the real estate markets. And it fueled a lot of inflation, that coupled with printing money. So we want to see rates, and when I say rates now, I'm talking about your average rate that you can get from a bank. For the last 20, 25 years, that rate has been around 5.5%. I believe that's kind of where the market wants to go. But if you stick around to the end, I'm going to talk about why I don't think that's going to happen anytime soon. So the next Fed meeting is November, I think, 1st. And then they're going to have one in December. and so on and so forth. And so I was talking to another guy who I trust a lot in multifamily, and he was saying, I think there's going to be maybe one more rate raise, one more rate hike before the end of the year. And this is the narrative that we've been hearing for probably 6-8 months, that they're going to do, another couple rate hikes before the end of the year. Well, August rolled around, they didn't do it. September rolled around, they didn't do it. October, they're not meeting. November, we'll see what they do. But when he said that, I said, well, are you a betting man? And he said, well, no, I'm not really a betting man. I said, well, there are guys that are betting men, and they buy futures on this stuff. They're basically betting on what the Fed is going to do. And so if you look at, there's a website called Fed Watch Tool, CME Fed Watch Tool. If you go to this website, you can kind of see what the traders and what the futures are telling us target rate probabilities on this stuff is. And so if you look at it, they're saying for November 1st, Fed meeting, the target rate probability for it to be 525 to 550, which is where it is now, that means no change, is 81.5%. So 18% of people think they're going to raise rates 25 basis points. 81% of these people think that they're going to stay. And these guys, these guys study the market. They're putting their money where their mouth is. So far, I've kind of followed this tool, and it's been fairly accurate in predicting what the Fed is going to do. Now, the further out you go, the less accurate it gets. But in December, which is going to be the last meeting of 2023, there's a 64% chance saying they're going to leave it the same. 32% say they're going to raise it 25 basis points, and 4% think they're going to do a 50 basis point hike. So still, even throughout the rest of the year, next month, it's an 81% probability that they're not going to raise rates. And then in December, it's a 65% chance that they're not going to raise rates. So that narrative is shifting. That narrative is now kind of turning to they're probably going to leave rates alone for the rest of the year and see what happens. Now, these guys can be wrong, right? Disclaimer, I can be completely wrong. And this episode is really more for just mental discourse and thinking about these things. You got to really do your own research. And as I get into this, I'm going to kind of talk about how a lot of this doesn't even really matter. It matters because it's important when you're talking to investors. It matters because you need to kind of understand where you're going. And I also want you to temper what you're willing to pay and the deals you're going to get into and not be too optimistic, but also not be too pessimistic. So we're looking at the probabilities. And so if I was a betting man, which I'm not really, I definitely aren't, I'm not betting on futures markets of the Fed rate, but it looks as though rates are going to stay flat. And I would say we're probably done. We're probably at the top, maybe one more rate hike, but I think we're probably just going to wait it out for a few months and see. So there's another chart that I like to look at, and that's called the expected 3 months average of SOFR. So SOFR is a rate that pretty much follows federal funds rate. And so they've got this cone. It kind of looks like a hurricane model, and it's basically trending flat up until March. And then in June, it drops a little bit, like I'm talking very little, like 10 basis points. Then it drops down, 25, 50 basis points. And by the time we get into the end of 2025, or the beginning of 2025, end of 2025, they're saying the expected rate is 400 basis points. So we're at 525 to 550. So 125 to 150 basis points. The expected is to drop by about a point to a point and a half from where we are now. And so if you think about that and you translate that into what the rates are today, if rates are 7.5%, maybe they'll drop to 6.5%. Rates are, some banks are offering 8%. They're going to drop down to 7%, maybe 6.5%. And what I'm trying to get across here is the market, right? People that are a lot smarter than me, hopefully, that are studying this stuff, they're not seeing us going back down to crazy low rates in the next year or two. That was the narrative when they first started jacking up the rates. Hey, they're going to jack up the rates, they're going to stop inflation, and then we're going to kind of go back to the good times. And I don't see that happening. I don't see us cutting rates aggressively over the next really even 2-3 years. So we're talking into 25, 26. So all the way into 25, 26, rates could still be 6.5% to 7%. For all we know, they could still be 8%. Once again, I'm talking about like the actual mortgage rate you're going to get on a mortgage, which is what matters to you. And so if you're doing that, and if you're looking at that and you believe that, if you believe the data or the projections of these people, what are you supposed to do with that? Because that's not very rosy, right? That's not like, oh my gosh, good times are here to stay. They're printing money. They're lowering rates. Real estate pricing is going through the roof. This is amazing. Okay, so this is where I'm talking about tempering what you're doing. So hang on, I'm going to get to that in a second. Because the flip side of that is the doomsday prophets, right? We may be going to 9%, 10%. I mean, think about the 80s when interest rates were at 14, 15, 16% for a home mortgage. Like, we're not even close to the amount of pain that we're going to experience. And first and foremost, the United States got to protect the dollar. That is their first and biggest priority. If the world loses confidence in the strength of the dollar, aka we have way too much inflation and it's not a good asset to hold anymore, that is catastrophic for the United States. So first and foremost, they've got to protect that. And so if they have to raise rates and they have to do money tightening policies and they have to do these kind of not fun things to keep the inflation in check, they are going to do that. They're going to pop that bubble before they pop the dollar bubble. They will not pop the dollar bubble. And I think we're really far away from that. It's really, kind of a popular thing to say with these talking heads that, the dollar is losing dominance. And what about the BRICS nations and cryptocurrency is going to overtake the dollar and the dollar is going to become irrelevant. I really don't think we're there. I'm not saying that could never happen, but I don't think we're close to that. Because the United States has the biggest military in the world. And when it comes down to it, the United States is going to protect the dollar, I believe, with military might if they have to. Right? We have a billion, trillion-dollar war machine backing our dollar. And I hate to be crass and I hate to break it down like that, but the United States will not voluntarily let other countries take away the dollar dominance. They will go to war over that issue if they have to. Now we're getting into crazy geopolitical stuff, but I'm just saying that's something that I'm not necessarily afraid of at this moment, that the dollar is going to hyperinflate and lose all value and going to be replaced with, the Chinese golden ruble, Bitcoin, crypto, whatever. No, I still think the dollar dominance is here to stay, at least for a good period of time. I don't know, 20, 50, 100 years, I'm not sure, but I don't think it's next year. And so I don't think we're falling off the cliff. People have PTSD. They think about 2008, 2009. They think about they bought a house and 2 years later they could have bought the same house for 50 cents on the dollar or 30 cents on the dollar. They thought about all the distressed sellers in the marketplace just dumping houses, all the banks foreclosing massive amounts, unemployment, double and triple what it was today. They think about this stuff and they think we're repeating history. We're going to do the same thing over and over. However, to get in a situation like that, what do you need? Well, you need distressed sellers. Okay? So let's look at the commercial office space arena. Commercial office space arena, they've got some distressed sellers. They've got people that paid way too much. They're not leasing them up. The companies that are leasing them are playing hardball. Some of them are not paying their rents. I just heard WeWork missed like a $95 million interest payment on one of their loans, on one of their buildings. And so you're hearing smatterings of this kind of thing happening. Large-scale office commercial defaults. And that's not really the asset class that I'm in. That's not the asset class that I'm talking about intelligently. It's not one that I invest in. Because I really do think that there is definitely troubled waters ahead. Now, in that chaos, I think the people that are well-positioned, that know that asset class and have cash and or have the ability to buy, they can buy those properties for significant discounts and they can repurpose them. They can repurpose them into, we're seeing malls repurposed into self-storage. We're seeing office space repurposed into condos and apartments. People are creative. They're not going to let a $1 billion building in the middle of, downtown LA sit vacant forever. But that stuff takes a long time to absorb. It takes a long time to foreclose. It takes a long time for stuff to get sold at auction. It takes a long time to be repurposed. But yes, I do think some of that's going to come and some of that is going to reset commercial real estate values. we're going to see some of that happen in multifamily, right? Why were cap rates compressing so tightly in 2021, 2022? Well, and when I say cap rate compressing, that means basically the cap rate is what you divide your net operating income to value the building. So the lower the cap rate, the more that building is worth. And so when you can borrow debt very, very cheaply, you can pay more. And so as people were paying more and paying more and paying more, those cap rates were going tighter and tighter and tighter. But a cap rate is essentially like, what can I get in a return if I bought this property all cash? So if you bought this property, let's say you bought $1 million apartment complex and it made 50 grand a year after you paid your expenses and you didn't have a mortgage, that's a 5% return on $1 million, 50 grand a year. That's a 5 cap deal. Okay. So if you're borrowing though, and you're borrowing above 5% interest, are you going to have any profits? Well, not really, depending on how much cash you put down. Maybe if you put down 50% cash, then your mortgage payment would break even with your net operating income. But most people aren't buying real estate to break even and make no cash flow and make no appreciation. And so as the rates going up, the cap rates are expanding. Cap rates expanding, meaning those properties are worth less. And we are definitely seeing that in apartment buildings. I've seen some of my apartment buildings, they're cash flowing the same, they're making the same amount of money, and yet they're worth less than they were a year and a half ago. Well, why? Well, because the debt is higher. It's going to be more difficult for somebody to pay that price and make the deal make sense to them, to be able to pay their mortgage and make money on it. And so what do? They pay less. And that's just the name of the game. We're seeing some of that in multifamily. We're seeing multifamily pricing come down, and that's a good thing, right? That's a good thing if you're trying to buy. It's not a great thing if you're trying to sell, but if you're trying to buy, you are getting better prices, much better prices than you did a year and a half ago. And here's where I think the fallacy is popping into people's head is like, wow, look at what multifamily's done. It's come down in price. Man, if I just wait another 6 months, another year and a half, maybe I can pick this stuff up for 30 cents on the dollar, 40 cents on the dollar. Is that going to happen? Well, I don't know, right? Nobody knows the future, but if I was a betting man, I would say the good times to buy, they are here now. The blood in the streets is here, right? Maybe it's going to get a little bit worse. Maybe it's going to start to get better, but we are pretty dang close to the bottom of this thing. And if you're waiting on the sidelines, waiting another 6 months, waiting another 12 months, you may be left just waiting forever, right? There's a lot of real estate investors that are trying to time the market and they're waiting for the absolute bottom to fall out before they'll buy. And look at what happened to them in COVID. Waiting for the bottom to fall out, prices definitely came down a little bit for a short window of time. But then boom, they came right back up, then exceeded it, then really, really exceeded it. So you don't want to be waiting for just too much blood in the streets and miss the opportunities and the deals that are right in front of you right now. Sellers are definitely more motivated to sell. They're not getting all cash offers, 5 or 6 offers at a time, close in 30 days, hard money day one. They're not getting that. They're willing to work with you. They're willing to let you get your lending in place. They're willing to let you crawl through the property, do your due diligence, make it make sense. They're willing to offer seller financing or partial seller financing. They're willing to get creative to move the deals. I was talking to a gentleman yesterday who's working a deal, and their loan is about $3 million and the property's worth about $3 million. So they've got their equity, they got their down payment. They probably put down $1 million or $2 million to buy this and do some rehabs. And yet the property, based on the cash it's producing, is only worth about $3 million. And so if they really want to move that, they're going to just have to sell that at their loan balance so they can pay off their loan. And in some cases, people are having to sell stuff at below loan balances. I was working a deal last week and my top number was about 10% below what the guy owed on it. And he wanted to sell it to me, but he couldn't because he couldn't pay off his mortgage. So he was trying to get another loan to pay off the balance of that loan so that I could buy the property. The deal didn't work out. But these are the kind of situations that we're seeing. Okay, these are people that they got into debt that is maturing and there are no other options for them. It's not worth enough to refinance it. They can't sell it for a profit. They can't even sell it for break even a lot of times. And so they're motivated to get it out the door because they're scared. They don't know how long we're going to be in. And if you look at the SOFR path, right, it looks like we're not going to see rates plummet anytime soon. And so if you're on a short horizon, you've got to do something. But why do we not think we're going to fall off a cliff, Jennings? Like, why are you somewhat optimistic in that? I mean, we've definitely slid. Values have come down. There's no denying that. But are we going to just go down to 50% off? Is it going to be, red tag sale on real estate everywhere? Here's what I'm thinking. Here's my pushback to that thesis. Going back to distressed sellers. So are there distressed sellers in multifamily? Yes, absolutely. There are. However, it's not the same as like commercial. We did not see people move out in droves during COVID. We are not experiencing massively high unemployment. We're not experiencing crazy delinquencies. We're not having to slash our rents to keep our properties full. Right? I manage, about 1,000 rental units, and that's a small demographic, but it's spread out over, a dozen properties or so. And our rental rates have trended steadily up throughout this last 3-4 year period. Even in the last year, we've been able to maintain or push rents minimally. Now, we've given some rent concessions. We've done some stuff to get people in the door, but people are still there. People are still paying. Our delinquency ratios have not risen. In fact, our delinquency ratios are better than they were a year ago. Part of that is management, but part of that is just the economy. Like, people are still willing to pay because what are their options? What are their options for like a C-class or B-class apartment? If they were to go out and buy a house 2 years ago, the average mortgage was, I think, $2,200, something like that. Now that same mortgage is $3,600. So home ownership is becoming less and less affordable for people. And so more and more people, their option is only to rent. They don't have the down payment. And even if they did, they can't handle a mortgage rate at 8%. Going back to distressed sellers, for the housing market, now I'm talking about single family housing, for the housing market to crash, you need a large demographic of people to be distressed and dump their property. But let's look at the data. You've got 37% of Americans don't even have a mortgage. So are they distressed? Not really. They've got to pay their taxes and they don't even have to pay insurance if they don't want to because they own it free and clear. But they got to pay their taxes. That's it. So, most property taxes on houses are $1,000 to $5,000 a year. So, $100 to $500 a month, most people can swing that for their single family primary residence. So that leaves like what? 63% of people that do have a mortgage. So of that, I think 60 something percent, 63% have a sub 4% mortgage. And about half of those have a sub 3% mortgage. So you're talking about 75% of all homes in America, they either have no mortgage or they got a mortgage under 4%. And this is a 30-year fixed amortization mortgage. They've got that rate for the next 30 years or 28 years at this point. So are they distressed? No. Look at what their options are. Even if they wanted to move, they've got to look at like, okay, well, if I move and I sell and I give up this mortgage, I've got to go buy wherever I want to move to, and I got to pay an 8% mortgage. I got to go from a 4% or 3.5% mortgage to 8%. I'm going to double my mortgage payment or more just to afford the same amount of house as I had before. So are you really going to be incentivized to do that? Probably not. Now, yes, there's always going to be people that got to move, their spouse passed away, they got to move into the nursing home, they got to sell, their job is moving them, there's a reason they have to move. But there's not a large swath of people that are in trouble like we saw in 2006, 7, 8, where it was just like, hey, I'm on a variable rate mortgage. I owe way more than this house is worth. I can't afford the payments. My payments are going up every month. I just got to walk away from this place and dump it. And even then, what do you think all those people did? Well, they rented, right? My dad, 16 rental homes. In 2007, 8, 9, he said, hey, my net worth on paper got cut in half, but my cash flow stayed the same People still paid my rents. My buildings were full. And you look at the chart, I think I did a show on this 2 weeks ago. You look at the chart of single or primary residence dwellings and what those rents, they just go straight up. From when they started tracking it in 1940 to here, 70 years or 80 years or whatever that is, it goes straight up. It flattens out in 2008, 9, 10, and then it keeps going back up. And so I don't see multifamily getting extremely distressed. Will there be sellers that are over their head? Yes. Will there be sellers that paid too much and they got to sell? Yes. But there's still a lot of people out there that they bought 5 years ago, 10 years ago, 15 years ago, 20 years ago. They got a ton of equity in the property. They're in it for $2 million and it's worth $8 million. It's worth $6 million. It doesn't matter to them. They can definitely refinance if their loan is maturing. They can definitely sell that property at a profit. Now there are people that are on bridge debt and it's maturing, and that is definitely going to affect the market. And we've slid some. We may slide more. I'm not certain of that, but I don't think we're going to fall off a cliff. So what my recommendation is, what does this all mean to you? You got to keep just buying good deals. Stick to your criteria. So your criteria has shifted. My underwriting criteria has shifted, mostly in the lending. Right now, you can only get 65 to 70% leverage on a deal. You used to be able to get 75 to 80%. So the leverage is cut down. You used to be able to get rates in the 3s, the 4s, the 5s all day long, no problem. Now they're in the high 6s for agency debt and the 7s, even 8% for regular commercial debt. So you've got to underwrite that like this is going to be my payment. And here's where I want you to think out in the future. When you're thinking about selling this property or refinancing this property in 2-3 years, don't be thinking, oh, well, rates will be at 5.5% by then. Rates will be at 6% by then. I'll be able to refinance everybody out. I'll be able to keep this thing in cash flow. I'll have better debt. Maybe, right? Maybe. And if that happens, I want you to do it. That's a great strategy. But if it doesn't, I don't want you to build your whole business plan on that. Because if we look at where the expected rates are going into 2026, March of 2026, we're still only at, we're only 150 basis points below where we are now. We're only 1.5 points below where we are now. And that's maybe not even right? Because if they start lowering rates too fast, prices are going to go up. Inflation is going to go up. And we're going to be battling the same problem all over again. And that's their number one priority. They're not going to lose that fight. They're going to keep on fighting that fight until they win. And so I think that we are going to see very, very gradual. But here's the key. When they start to pivot, right? Let's say fast forward into 2024. Let's say in June, they decide, hey, we're going to lower rates 25 basis points. Market starts to feel a little bit good. People get a little bit excited. And then in September, they drop it another 25 basis points. Oh, wow, it's happening. They're pivoting. And then, December, maybe they drop it another 25 basis points. The consensus right now is about a 50-point drop next year. So if that happens, that confirms what people are thinking, risk on. People are going to be like, hey, it's over. We made it. They soft landed it. Inflation's under control. Buy. What do you think is going to happen to real estate? It's going to go up. And those people that were waiting for that 50% drop, oh, I'm going to be so smart. I got all this dry powder. I'm not buying a thing for years because I'm just waiting for the perfect opportunity. All of a sudden, boom. You see that with homeowners, right? All the people that were waiting on the sidelines in 16, 17, 18, 19, 20, 21, I'm going to wait until, prices come down. I'm going to wait until, things slow down with COVID. I'm going to wait until prices come down. Right now they're saying, well, I'm going to wait until prices come down. I'm going to wait till rates come down. When rates come down, prices are going to go up. And the same thing is going to happen with multifamily. So should you go out there and buy that shining gem, perfectly manicured retail price deal? No, absolutely not. That's not my strategy. That shouldn't be your strategy unless you're, a very, very wealthy insurance company just looking to park cash for tax savings. That's not your deal. But if you can find something that's got a problem that you can solve, right? It's got some vacancy. It's got some rents under market. It needs some renovations. There's a way to push that NOI up and you can solve that problem, then I don't think you should just wait on the sidelines waiting for further and further and further pain because it may never come. And by the time the Fed pivots and by the time everyone realizes, hey, this is over, we made it through, it's going to be too late. So I know I just spit out a lot of opinions there and a lot of whatever, and you probably have your own thoughts on this. And I want you to do your own research and feel confident and comfortable in whatever you're doing. But the people that do best aren't trying to time the market. They've got their strategy. They're constantly looking at what works, right? If this deal will pencil out at 7.5% interest and I can cash flow and I can pay my debt and I can cover my expenses and I've got an ability to raise the value of the building by renovations or lease ups or whatever I'm going to do, then I'm going to proceed in a careful and disciplined manner, because I know that in 5 years or in 10 years or whatever, when I go to sell that property, I'll have amortized debt, inflation's still going to be there, rents are still going to go up, and maybe I'll get lucky. Maybe they will lower rates and that's going to juice my returns a little bit. But even if they don't, I'm still going to be okay. And even if they raise rates, I've still paid down debt, I've still improved my property, I've still raised rents, I've still increased my NOI, I'm still fine. Right? So you can protect the downside, but be in the position to catch that upside. This is what I'm trying to get out to you. So don't be bound up in fear that some cataclysmic event is right around the corner when it's not. Probabilities really don't say that it is. You typically get hit by the train you don't see. They see this problem. They see the inflation. They're trying to soft land the plane, and I believe that they will. I think back to 2010, dude, I didn't even know what was going on until years later. I was like, what even caused all this? It's a huge confusion, at least among the general public, that, it was them selling, these bad mortgages and lumping them into tranches and selling them to the government, and then massive defaults because these people could never have afforded the house in the first place. We don't have that issue, right? Underwriting, loan to values, all that stuff, it did remain sound, at least with multifamily and single family throughout the last 5-6 years. I don't think we have a huge wave of defaults coming because people could never afford that. Back then we were doing liar loans. Liar loans is where you can just state what you make. Oh, I make $200,000 a year. And the bank will say, okay, you make $200,000 a year. They don't check your employment records. They don't check your tax returns. They're not verifying that you're actually making that. And if you've gotten a loan in the last 5 years, they're crawling through all that stuff. They're verifying your income. They're verifying your debt. They're verifying your global cash flows. Can you afford this note? Are you going to be able to swing it or not? And if you can't, they didn't give you the loan. Whereas before, it was like if you signed for it and you said you could do it, they were giving you the money. Why? Because they knew they could lump that mortgage and pass it up to the next guy, which was the federal government who was going to take the hit. And when the federal government took too many hits and the wave of foreclosures was too great, the whole thing collapsed. So think critically. Are we in that same scenario? I don't think so. Is that stuff going to happen in the commercial office space? Yeah, probably. And if you're in that space, I'd be working hard. I'd be trying to keep my place full. I'd be trying to keep my rents up. And I'd be also looking for opportunity. I'd be looking for deals and how can I repurpose and reposition this stuff. But in multifamily, everybody's got to have a place to live, right? Everybody has to. It's a need. It's not a want, right? Office space in today's time with networks and computers and internet and all that stuff, it's kind of like, yeah, the big office is nice, but most businesses don't absolutely have to have that. A need, right? A single family home to live in, an apartment to live in that costs $900 a month. Like that is a need. You can't function very well in society without that. And so that's what I have invested in and will invest in. And that's why I think it's a pretty stable investment. So guys, I'd love to hear your thoughts. What am I missing? Am I saying something that's off the wall? Am I not taking something into account? Shoot me a DM. I'd love to chat with you about it. So have a great week, and don't forget to take some time to unlock your life. Peace.
This is thepodcastfactory.com.